Welcome back to the channel. Big tech stocks are cheap. This is the arguable statement, but in this video, I will walk you through tons of charts, data, and facts why I believe that some of the big tech stocks are easy money for long-term investors. Currently, they are providing the generational buying opportunity. In this video, I will show you which big tech stocks I was buying during the last week. I will walk you through Alphabet's earnings and I will show you how Google just demolished the numbers, both top and bottom line. And finally, I will share the updates from my public YouTube portfolio and we will see how it's doing. I prepared for you guys beast of a video, 33 slides. The only thing I need from you is please smash that like button for the YouTube algorithm. What's going on, investors? Hopefully guys are doing well out there. This is from Yardini Research. If you can see, the red line is Magnificent 7. Meanwhile, the blue line is S&P 500. The forward revenue growth for the S&P 500 is around 5.3%, but for Magnificent 7, it's north of 12%. So it's more than twice. The revenue growth projected for Magnificent 7 is almost twice for the average S&P 500 company. Now, what about the earnings? For the earnings, we have a similar picture. For S&P 500, the earnings are projected to be 11.5%. Meanwhile, for Magnificent 7, 17.4%. So it's a huge difference here for the earnings per share as well. Now, what about the profitability? For the profitability, we have even more interesting picture. Blue line is S&P 500 profit margin. Green line, S&P 500 minus Magnificent 7. And the red line, Magnificent 7 profit margin. You can see Magnificent 7 has 26% profit margin. Meanwhile, the S&P 500 has just 13.5 and S&P minus Magnificent 7 has just 12% profit margin. So this is a huge difference in profitability for these companies. Forward price to earnings for Magnificent 7 is close to 22. Meanwhile, for S&P 500 blue line, the forward earnings is 19.2. So you can see how close they are. Meanwhile, we just saw the margins are basically double. The revenue growth more than double. Earnings growth has significant margin between S&P and Magnificent 7. But meanwhile, the valuation they are trading is just 5%, 10%, 7% difference. So this is a big delta where the money is going to be made. Most of the Magnificent 7 are monopolistic company. They are going to grow for the long time in the future. For the next 3 to 5 years, Magnificent 7 is projected to grow 18.8%, and for the forward PE, it's just 22.8. So if you calculate the PEG ratio, you will see that the PEG is actually close to 1, which is by Peter Lynch, is already quite cheap. Quarterly profit margin, this is ridiculous how profitable this company are. You can see the S&P 500 is blue line, meanwhile Magnificent 7 is green line. The difference is very, very large. Meanwhile, what do we have from the performance point of view for year to date? For the S&P 500 is down 8.6%. Meanwhile, Meta minus 11, Microsoft minus 11, Amazon minus 17, Alphabet minus 18, Apple minus 18, Nvidia minus 23%, and Tesla whopping minus 37%. So Magnificent 7 had significant correction because of the tariffs and macro uncertainties, but I believe they are providing a generational buying opportunity here. Looking at valuation here, enterprise value to operating cash flow 12.17. Meanwhile, 10 years average is 13.47. Currently, there was a lot of uncertainties about Google, about the breakup, about the search market share, and so on and so forth. But during the earnings, Google give a lot of answer for all those questions. We will be talking later on. From the business perspective, the search grows 10%, while everybody is saying that search is dead, not growing, and Google is losing market share to ChatGPT. The Google just printed in 3 months $50 billion in revenue from search and advertising. YouTube still nicely growing 10%. Google services 20%. This is recurring stable revenue 20%. Very, very nice. $10 billion in a quarter. And for the Google Cloud, absolute blockbuster, 28% year over year. Meanwhile, the profitability is going through the roof. Again, we will be talking about it a little bit later on in the video when we will be going through Google's earnings. Next company, Magnificent 7, Apple. The 10 years medium for the enterprise value to operating cash flow is 16.8. Meanwhile, currently Apple is trading at around 20. 20. I believe that Apple is not really a buy here. So Apple is one of the Max 7 I would not buy. The reason here is very simple. The main business is iPhone business is not growing. The revenue is declining year over year. Meanwhile, we have a lot of uncertainties with the tariffs, and Apple has 90% of the manufacturing in China. Mac nicely growing 16%, iPad nicely growing, but this is a smaller part of the business, as you can see. And services very nice, 14%, but 26 billion for the services, and meanwhile $70 billion in iPhone. So iPhone is still significant part of the Apple business, and I see a simple bear case here with the uncertainties. Apple cannot just simply take all the manufacturing and move to another country overnight. Need time for that. The second easy money stock I see in the stock market among big tech is Amazon. Medium enterprise value to operating cash flow is 19, currently trading as 14, dirt cheap. A lot of margin expansion coming because of the robotics and efficiency improvement. The retail margins are going to the moon. Of course, Amazon will be affected by tariffs. Currently, Amazon is doing 75 billion in online stores. Many Chinese sellers are operating in Amazon.com. Of course, this will be affected. Some of them will not be able to do the profitable business. Some of them leave the platform. But I believe sellers from other countries will be able to replace those Chinese sellers. Or if the tensions between US and China will cool down, I believe there will be a bull case for Amazon. In terms of the advertising, if we are facing a recession, probably this 18% year-over-year growth will be lower than 18%. And also for the subscription, I believe this is a kind of recession proof. Probably no one will cancel Amazon Prime just because the recession is coming. In terms of the AWS, Google just showed that Google Cloud grew 28% in a recent quarter. I believe that Amazon has a chance to accelerate from 19% even higher for the AWS business. This will be very bullish for Amazon and for the margins in overall. If you are enjoying video so far, please consider subscribing to the channel. On my channel, I do fundamental analysis, I run public portfolio, I do educational videos. If any of that interests you, welcome to join, and we will continue. Coming to the next Max 7 company, Nvidia. Enterprise value to operating cash flow medium is 31.29. Meanwhile, currently Nvidia is trading 24.41. You had a few chances to buy Nvidia at these prices. One time in 2019, 2020, 23, 24, and now. So I believe Nvidia is cheap here. And from the Google's earnings, they confirmed $75 billion in capital expenditures, and the Google Cloud is growing like there is no tomorrow. And from AWS and from Microsoft Azure, we will see will they confirm their guidance for capital expenditures. But currently, Nvidia is dirt cheap comparing to the growth this company is providing, and comparing to the valuation we need to pay for this company at these prices. Of course, the biggest part of Nvidia is data center, $35 billion and growing 16% quarter over quarter. Attention here, this is quarter over quarter, year over year, close to 60% growth for Nvidia. And for smaller parts of the business, including gaming, professional visualization, automotive, and stuff like this, also nice growth. Meanwhile, the gaming is declining quarter over quarter. So over here, everybody is looking, of course, at data centers and looking if the growth is going to slow. From Google, we see that growth is not going to slow, and AI is here to stay, and hyperscalers will continue to invest, but we will see more from Microsoft, Amazon, and finally Nvidia will be reporting last. So we will see what guidance Nvidia will give us for the next quarters and years. Meta Platforms, enterprise value to operating cash flow currently trading at 12.43, medium 14.46. For the Meta over here, I would say this is not as good buy as in 2023 when Meta was trading at enterprise value to operating cash flow at 5. Currently we are at 12, and this is around average. But I would say that if we are coming into the recession, and also because of the tensions between US and China, we saw a lot of news that Shein and also Temu cutting the advertising budget, and most of the advertising they were doing is inside the Meta Platforms products, including Facebook and including Instagram. So in this case, there was a report that Meta could lose $7 billion in revenue per year from these two Chinese giants. So in this case, I believe that there is some uncertainties still there in terms of the tariffs, in terms of tensions, and also incoming recession. And if Meta would be trading at 10 currently, or even 8, I think this would be a good buy, but currently at 12.43, I think Meta is not the most obvious buy in the market comparing to Google and Amazon, for example. In terms of the business, of course, Meta is mostly advertising company, $46 billion from the advertising, from the Facebook, Instagram, WhatsApp, Messenger, and also Meta has Reality Labs, mostly money losing business, losing $5 billion in operating profit. Meanwhile, Family of Apps printing $28 billion. So mostly this is the advertising company, most of the money coming from here. So the risks are recession, the risks are advertising budgets from Chinese giants like Temu, Shein, and others. Coming to the next company in Max 7, Tesla, enterprise value to operating cash flow 49. Meanwhile, the average is 46. I would say Tesla here is not an easy money stock, because Tesla is kind of trading in average over the next 5 years. But the problem here is that the main business for Tesla is in decline. Currently, Tesla already reported earnings in this earnings season, decline for the auto business 21%, absolute disaster. Meanwhile, the energy is nicely growing 67%, services nicely growing 15%, but most of the money is still coming from auto. Market share lost across the board, North America, Europe, China, everywhere market share lost. The Elon Musk, of course, was pumping the stock to give a lot of promises about the Optimus, about the self-driving and all those kind of stuff. Meanwhile, Google is already operating in multiple cities with its Waymo, with self-driving cars, and Tesla is only going to start from the June of this year, and they are going to start with 10 to 20 vehicles and then scale, of course, much faster based on the regulatory environment and stuff. But I believe that Tesla is quite risky here, because I believe that Optimus will take some time, and probably Wall Street, which is looking from quarter to quarter, from year to year, to report good KPI and get the bonus, probably they will not be able to wait for the next 5 years when the robots are coming for the consumer. And also, initially the Optimus will come to improve the efficiency in a factory, so actually it will not be like significant money generation business. But when the Optimus is coming to consumer like you and me, I would say at that time the margins will go significantly higher for Tesla. So I would say Tesla is not easy money here comparing to Amazon, Google, and probably Meta. Coming to the next company in Max 7, Microsoft, enterprise value to operating cash flow of 20. Meanwhile, the average is 23, and I would say that this 23 average is a little bit cheap, because Microsoft is one of the best company in the world, huge moat, recurring revenue, stable. Microsoft actually did not decline significantly during these tariff uncertainties, because Microsoft is just printing money from the Office, Excel, all those Office products. Azure is continue to grow with 20% year over year, and huge operating margins of 48%. So everything is good with Microsoft, except that the price is already corrected. So I believe that Microsoft is a buy here. I believe that with Microsoft you outperform the market over the next 5 years, but it's not easy money. Coming to the next topic of the video, Google yesterday just smashed earnings. Google reported yesterday after the bell. Q1 revenue increased 12% and 14% in constant currency basis. Google services grew 10%. Meanwhile, all the bears are saying that Google search is dead. Google Cloud revenue increased 28%, whopping 28%. Total operating income increased 20%, and operating margin expanded to 34%. Absolutely mind-blowing numbers. Net income increased 46% and EPS increased 49%. But this kind of huge growth for net income and EPS due to the unrealized gains. So I would actually focus mostly on operating income increased 20%. This is much more important number than this 49% increase in the earnings per share. Company announced 5% increase in dividend, and currently the dividend payment will be 21 cents per share. Thunder is saying that they are pleased with the quarter results. They are emphasizing AI. They are emphasizing release of Gemini 2.5. They are emphasizing how good currently they are doing with their AI overviews, and they are also saying that from the perspective of Google One and YouTube subscription, they already overpassed 270 paid subscriptions. This is very nice, because this is a revenue, recurring revenue, and very stable revenue. In coming to the income statement, the revenue grew 12%, cost of revenue grew 8%, research and development increased 14%. This is very nice to see, because at this stage we need to keep investing into the business and continue growing, and we can see from the GCP 28% growth it's working. Sales and and marketing decreased 4% year over year, and general administrative increased 17%. This is not very nice to see. But meanwhile, total cost and expenses grew just 8%, which leads to income from operations grew 20%. Net income grew 47%, but as I said, I would ignore this number. Mostly, I would focus on the income from operations. This is much more important number than net income and the diluted EPS. Revenue is a bit decelerating from the Q1 of 2024. The growth was 15%. Currently, we're decelerating to 12% growth, but this is still very nice. Low double-digit growth for such a large companies and such a company which is currently trading at dirt cheap valuations. Operating margins expanded from 31.6% to almost 34%. Absolutely mind-blowing number. And for Google services, the margin went from 39% to 42%. So Google has a lot of pricing power. If you need to advertise, you go either to Google or Meta, because advertising in Amazon.com mostly will be related to the products you can actually purchase on Amazon. So in this case, this kind of two monopolies you can go to. And as we can see from the margins, Google has a lot of pricing power. Google Cloud just absolutely blockbuster of this quarter. The revenue is not decelerating, 28% in the last year and 28% again in this year, and operating margins almost doubled from 9.4% to 17.8%. The demand for GCP is unreal, and when the bears are trying to make the point that hyperscalers are spending too much money on capital expenditures, when I see these kind of numbers, when I see this kind of margins and this kind of revenue growth, I would like this 17 billion will be even more. I would like Google to invest even more money into capital expenditures, but we can see that the capital expenditures growth is accelerating again from quarter over quarter to 43%. But again, looking at the numbers here, I'm totally supporting this investment because I believe the return on investment will be definitely coming. The margins for GCP currently not close, of course, to AWS and Azure margins, but it's already close to 20%. And for AWS, it's north of 35% in the best quarters. So I believe that Google has a lot of potentials to expand margins even more in the coming years. In the earnings call, Sundar mentioned that Waymo paid weekly driverless rides currently is reaching 250,000. This is absolutely mind-blowing exponential chart. And another point bears are making is that Google search is dead. I would pay your attention that ChatGPT was introduced in September 2021, and from September 2021 to March 2025, the Google search and other revenues went from $138 billion to $203 billion in the last 12 months. This is not a dying business. Now, do I believe that Google is a buy here? Absolutely. Google is easy money here, and modeling just 10% over the next 5 years, the net income margin will be expanding from 28% to 30%, and we will be assigning 24% multiple for Google in the end of 2029. Google is paying dividend, and also Google is doing buybacks. And by the way, Google authorized another $70 billion in buybacks in the latest quarter. After taking into consideration all these assumptions, Google can deliver 160% growth over the next 5 years, or north of 21% CAGR every single year. Google is easy money here, and I was buying Google just last week. From the technical perspective, you can see here was previous all-time high, and currently we break all-time high. We retested one time, we retested second time, and currently the support was exactly the previous all-time high plus this 10 years trend. So I believe Google is strong in terms of the chart, and bears could not take Google to break this trend down. So bulls step in and bulls put the buying pressure, and currently Google is bouncing back, and watching at the numbers Google just provided in the latest quarter, I believe that Google is going much higher from here. Coming to the public portfolio update, if you remember, I announced that I will be running 10,000 public YouTube portfolio, and currently I already did some buys. Last week I was buying Amazon. As I mentioned, Amazon is totally easy money here. I was buying Google, 8.3% for Google, 18% for Amazon. I bought Elf Beauty. There are a lot of tensions between China and US, but I think this will going to manage, and this stock fell too much. So I think this is too much to ignore, and I will be doing fundamental analysis later on the channel about the Elf Beauty. I bought Meta, 4.5%. I believe Meta is not as easy money as Amazon and Google, so my position is lower. I bought Nvidia, 5.2% for Nvidia. I believe Nvidia is too cheap to ignore here, and watching at the numbers of capital expenditure from Google and reconfirmation of 75 billion capital expenditures in the future for the next year, we will see what Amazon and Microsoft will tell during their earnings call, but so far looks good for for Nvidia. And of course, I bought Microsoft. For Microsoft, I bought just 3.8%, even though this is core foundational stock for me. So these three is core foundational stocks: Amazon, Google, and also Microsoft. I would like to make them, for Amazon, I would like to have 20%. For Google and Microsoft, I would like to have 10 and 10%. So this is core foundational stocks for me. And I just did not put too much money yet for the Microsoft because I'm just waiting for better buying opportunities. For Amazon and Google, I see this as easy money today, right now. But for Microsoft, I would like to see a bit more cheaper prices because Microsoft did not really crash too much significantly, because everybody knows this is a strong company and everybody knows it will not be affected so much from tariffs as other players. And if you can see, I still have 50% cash in my portfolio. I will do more buys and I will let you know on the channel. If you want more real-time notifications about what I buy and when I buy, please consider joining our Discord channel. This is absolutely for free. We have the best investing community in the world. Welcome to join. The link in the description below and in the pinned comment. If you enjoyed this video, please consider subscribing to the channel. On the channel, I do fundamental analysis, I run public portfolio, I do educational videos. If any of that interests you, please consider subscribing and welcome to join. Thank you so much, friend, for stopping by. I appreciate you and I will see you in the next one.